Meet Alex and Ryan. Alex buys a $250,000 rental property. Ryan dumps the exact same cash into an S&P 500 index fund. Both of them think they're financial geniuses who cracked the code to wealth. And they're both wrong, because one of them forgot to count the hours, and the other forgot to count the zeros. When you run the real math over 20 years, the gap between their bank accounts will make your stomach drop. Let's keep the playing field completely fair. Alex and Ryan both start with $50,000 in savings, earn $55,000 a year, and live in the exact same city. The only difference, what they do with that 50 grand? Alex puts $50,000 down on a $250,000 rental house at 7% interest. His mortgage is $1,330 a month. He finds a tenant paying $1,800. On paper, that's $470 a month in pure profit before spending a single extra dime. Alex feels unstoppable. Ryan? He drops his $50,000 into a boring total stock market index fund, sets up an automatic $300 monthly deposit, and goes back to sleep. On day one, Alex has a house, a tenant, and a flex for dinner parties. Ryan has a PDF confirmation email. But social proof isn't math. For the first couple of years, real estate feels like a cheat code. Alex's tenant pays the bill, building his equity while saving him a few bucks on taxes. Ryan logs into his brokerage once a quarter, sees his money wiggle up and down, and watches paint dry. Year 1, $55,000. Year 2, $61,000. No keys, no flex, just a line graph. Then year 3 hits. Alex collected $64,800 in total rent and paid $47,880 in mortgage payments. On paper, he's up nearly $17,000. Then the real world enters the chat. $9,000 went to property taxes, $4,500 to insurance. A water heater blew up for $1,200. A roof leak cost $2,800. And a 1-month vacancy cost him $1,800 in lost rent plus $600 to clean up. Alex's real net profit over 3 years isn't $17,000, it's barely $3,000, and that doesn't count the late-night tenant calls or weekend repair trips. Meanwhile, Ryan put in $50,000 plus his $300 monthly deposits. At an average 10% annual return, his portfolio is sitting at $76,000. Total time spent managing it? 0 hours. Why does real estate cash flow trick people? Because human beings suck at accounting for hidden costs. Every real estate guru on social media flexes gross rent. Nobody posts about the 1 to 2% rule. The fact that you must set aside $2,500 to $5,000 every year just to keep a $250,000 structure from falling apart. They don't talk about capital expenditures. Roofs die after 20 years. Furnaces die after 15. These aren't surprises, they're guaranteed $10,000 invoices waiting to hit your bank account. By year 10, Alex's property appreciated to $340,000, leaving him with around $175,000 in equity thanks to leverage. But between repairs, taxes, and interest, he spent thousands out of pocket to keep it running. Ryan's index fund, sitting at roughly $170,000. He's neck and neck with Alex in total net worth, except Ryan never swung a hammer, negotiated with a bad tenant, or lost a minute of sleep. This is where the story completely splits. By year 20, Alex's property is worth around $475,000, and his mortgage is practically paid off. His equity is pushing $450,000. But after 2 decades of tenant turnover, property taxes, structural repairs, and landlording headaches, his net cash in pocket flow is only $50,000 to $80,000 total. Now look at Ryan, at a standard 10% average market return with his $300 monthly contributions. Ryan's initial $50,000 has exploded to over $440,000. They end up with almost the exact same wealth, around $450,000 each. But Alex worked for his net worth as a part-time property manager. Ryan simply waited for his. And here's the kicker. If Ryan added just $200 extra a month to his investments, bringing it to $500 monthly, his 20-year portfolio skyrockets to nearly $600,000. In stock investing, adding cash scales your wealth exponentially through compounding. In real estate, adding cash usually means taking on another 30-year mortgage and doubling your workload. Does this mean real estate is a scam and stocks always win? Absolute nonsense. Stocks have brutal volatility. In 2008, the market crashed 37%. In March 2020, it plummeted 34% in 30 days. Watching $150,000 drop to $95,000 on a screen causes real panic, and most amateur investors sell at the bottom. Real estate gives you 5-to-1 leverage. Alex used $50,000 to control $250,000 in assets, something you can't safely do in stocks. Plus, real estate unlocks tax shelters like depreciation and 1,031 tax-free exchanges that stock traders can only dream of. Real estate wins if you treat it like an actual business, buy at high rent-to-price ratios, or use strategies like house hacking. The ultimate trap isn't stocks, and it isn't real estate. The trap is picking either one based on a flashy 60-second video without running the full math on your money, your risk tolerance, and your time. Wall Street and real estate gurus rely on you only looking at half the equation so they can sell you their courses or take your fees. If you want to dodge financial traps, see the real math behind wealth building and make your money work for you instead of working for your money. Hit the subscribe button. We break down the raw economy every single week without the guru fluff. Stay sharp and run your numbers.